Is it really too late to invest in Nvidia? This is a company that is up 263% over the last 12 months, yet we have analysts giving price targets of $1,600, which is nearly double the current trading price. But is it really undervalued, and should we be looking to add to our portfolio? We're going to take a look at the company. We'll have a quick refresher on their top line revenue growth as well as their bottom line net income growth. We'll also remind ourselves of the health of this company, their cash versus their total debt. And not only are we going to look at their total return performance versus others in the Mag 7 over the last few years, but we'll also discuss the forward PEs of Nvidia and the others in the Magnificent 7 to really understand if they are one of the most expensive out of the lot. We'll remind ourselves of institutions if they are buying year on year and over the more recent quarters, and discuss some more insider selling that we have noted just last week by a number of directors. And as always, we'll look at their free cash flow metrics, we'll look at the ROIC, their net debt to EBITDA, understand if this is a company we want to be investing for the long term. And we'll also talk about something that is happening on Monday, which could be a very bullish sign for Nvidia. And it is CEO talking, and we're going to discuss that very soon. We'll also talk about this article where it does discuss 3 brilliant reasons to invest in Nvidia stock right now at the current trading price. And we'll remind ourselves exactly of the revenue growth. We'll look at some of the other metrics just in case we do have people who have missed this. And we'll look at some other metrics in detail to understand the real growth of this company. And we want to answer the question whether or not it is too late to buy Nvidia, now seeing it has had a lot of growth. Don't forget, we're going to run it through not just the valuation model to get to our intrinsic value, but we're also going to take a look at 3 different growth rates, again, a low, medium, and high, to understand what expectation we should have if this company is going to double, or if this company is just going to, at a minimum, give around 10 to 20% returns. So let's start off with the historical performance again. Now up 263% over the last 12 months. Over the last 10 years, astronomical 19,509%. Absolutely incredible. Although we do note they did have a little bit of a pullback, so their all-time highs not too long ago, $974, nearly $100 below that current price, yet they are still trading in the mid to upper end. They do offer a yield, although very small, and they don't tend to increase that year on year at 0.02%. And we do see a market cap of 2.16 trillion and a forward PE sitting at 35.66. Now, we're going to take a look at their top line revenue growth, and what we can see is it has grown very rapidly over the last 5 years, by around 6 times, going from 11 billion in 2020 to 61 billion. And we can note those increases year on year. 2022 to 2023, it did remain fairly flat, but it did more than double over that period from 23 to 24. And when we take a look at their bottom line net income, we see a very similar story. 3 billion, in fact, more than 10 times over the last 5 years to 30 billion. But we can see the inconsistencies. It did increase from 2020 to 2022 before dropping quite dramatically and then rebounding very sharply. So in terms of those numbers, we can see looking very positive in terms of their top line growth as well as bottom line. And what we also want to remind you, we can see here in a bar chart format, the growth has been very strong. We note that flat period 22 to 23, and then it really did take off. But what we want to really emphasize here is not the fact that they've had dramatic growth over the last 5 years, but their operating margin has increased significantly. So we see operational efficiencies going from 34% to 61%. So that is a very fatal combination when a company increases both the top line dramatically as well as the operating margin. Very, very positive. And we can also show here that their largest area of growth over the period has been that data center, from 40% in FY21 to 78% in FY24. And what we also want to point out is there are a lot of positive metrics that have seen growth. Operating income notably from 3.7 billion to 37, so 10 times growth over the last 5 years. We see the free cash flow margin grow as well, not as dramatically as the operating income, nonetheless very large growth. And we can see the same for both the operating cash flow as well as the cash balance year on year. So lots of positives to take when looking at these numbers. And we also want to reflect that when we do look at the health of this company, their total cash versus total debt, it's gone from 11 billion to 26 billion. So they do sit on a very large amount of cash and short-term investments. And they do have a very strong balance sheet, because when we look at that total debt numerically and directionally, whilst it has increased from 2.6 billion to 11 billion, they still hold a large amount of cash versus that total debt. So they could pay it all off in one day if they needed to. So no real worries when we do analyze that. Now we'll look very quickly at the total return, and then we'll compare the forward P's of the Mag 7. But we have Apple, Tesla, Amazon, Microsoft, Meta and Google. What we can see over the last 12 months, very strong performance, up 263%, the best performing by quite some margin over that period. When we extend that to the last 5 years, again, very, very strong by quite some margin, 1,983%. But do bear in mind that past performance isn't an indicator of future performance. Now, when we take a look at the forward P of the Magnificent 7, we can in fact note that Nvidia isn't the most expensive on a forward P basis. In fact, coming in at around 32.1, although this is around 1 or 2 weeks out of date. We can see here that Tesla is far more costly in terms of that valuation. So is Microsoft, as we see here at 34.8, as well as Amazon. They are, though, more expensive on a valuation on a forward P basis, as we can see, than both Meta and Google as well as Apple. So whilst you may see they have been on a very large run, you may think, wow, they are essentially very, very ludicrous in the valuation. On a forward P, they aren't even the most expensive in relation to the Magnificent 7. And I would argue that Nvidia is a much better bet in terms of long-term returns than Tesla that we see here, that is far costlier on a forward P basis. But anyway, very important just to highlight this, just in case you were thinking that they were very expensive on a forward P in relation to others in the Mag 7. Now, institutional ownership, 65%, and we can see whilst there has been a fair amount of selling by the institutions over the last 12 months, there has been a lot more buying over the same period, a large buy in Q2, and whilst we know in Q3 there was a little bit more selling than buying, in the more recent quarter, 40 billion versus 12 billion, institutions are still buying Nvidia stock. So something just to consider. Don't rely on it for your investment decision and always do your own due diligence, but it is interesting to note. Now, we do see, in fact, the latest sale by Insiders Director Mark A. Stevens on the 7th of March, so around 8 days ago. We do, in fact, see they sold around 21,750 shares, and we see a price of $919, pocketing him just under $20 million. Now, since then, the share price is down around 4.5%, but even after the other insiders have sold at the beginning of March, we always say this isn't necessarily a bearish indicator, as they sell for many reasons. Plus, the first 3 directors that did sell, we can see since then the share price has increased. Nonetheless, always like to be transparent on this just to show you the insider buyers and sells. In terms of buys, there is nothing to note. Now, just to let you know that the CEO will be discussing the future of AI at one of these technological conferences on Monday, so it will be good to tune in to see what he says. How that will have an effect on their share price, no one knows. But as always, he could say something that does give us a bit more information about the company moving forwards. So be sure to tune in, and we will do an episode later on just to go through what he discussed, if there are any important pieces of information that we want to bring to your attention. Now, before we take a look and remind ourselves of these metrics and get to the valuation, we can take a look at 3 brilliant reasons from this article that you should be looking to invest in Nvidia stock right now. So the first one that we can see here is that the GPU demand is still expanding, and that they do believe that the margins is going to be increasing. They believe the demand is going to be increasing for Nvidia as well. And whilst their revenue the last quarter had soared rapidly, they expect that this will continue throughout the years. As we can see, their revenue was up, in fact, 265% to 22.1 billion, giving their full year, as we ran through, 61 billion. So lots of analysts believing there is more in store for this GPU production, which will help increase their top line, and you would expect to increase their margins. So one thing to note before we look at the point 2, they do believe, we can see here the research, the GPU market expanding to 773 billion by 2032 of which Nvidia holds a massive grip on this market, and we will look at this very shortly at their market share. Second point to note here is that the AI market is huge, and we have covered this in other videos, with Bloomberg believing that the market will be worth around 1.3 trillion by 2032, and they talk about how this hasn't really been integrated into the different workflows, so they do see the demand for these products that Nvidia are producing increasing rapidly over the next 10 years, and this has essentially just started now. On top of that, they discuss what we just went through briefly, that the stock isn't as expensive as you think when you compare it to the forward PE. As we can see here, it is looking right now at around a 37.68, but it does depend on the numbers the articles take, so roughly around that 35 to 37 PE. And as we mentioned, there are others in the Mag 7 that are more expensive on this valuation basis than Nvidia. Finally, the one thing I wanted to point out from this article about talking about is it too late to buy this company was the percentages of their market share. Now, what they do talk about here is we can see they say that Nvidia is the leading provider of GPUs in data centers, and they hold a 98% of that market share, which is massive. And they also talk about using the processors for AI and how they have a 95% share of this market. So lots of positives for Nvidia moving forwards, but it does always come down to the valuation, as we can see here from this article which was released yesterday, that they do have a 36 forward PE. So let's get into the actual metrics, and what we can see, their free cash flow has increased from 36 cents in 2015 to 10.90 and is expected to double in 2025, so 100% growth. Remember that, it is key for when we do look at the valuation. But we can see it has been very dramatic. In fact, the jump from 23 to 24 has been incredible. Sales growth, triple-digit increases in 2024, absolutely incredible. Pretty flat in 2023, so it's surprising that they bounced very strongly, and in fact, before then, double-digit increases in 2021 and 2022. So when you look at it over the longer term, it has been incredible, the journey for Nvidia at this point now. 4.68 billion to 61 billion in 2024, and it doesn't look like stopping anytime soon. In terms of shares outstanding, they have done share buybacks. They've also issued shares. Your position, whilst it would be a net dilution, so they have issued shares to dilute your position from 2.25 billion to 2.49. In this special case, you probably wouldn't care as a shareholder, given the returns you would have had, as we can see, over the last 10 years of 19,509%. So in terms of the other metrics, when we look at the ROIC, and we want to see 10% or more, if you want to be semiconductor industry specific, above 12%, well, they've done that pretty much every single year, year on year. 61 in the more recent year at 2024. So very strong. We love to see that. It does give us faith that management are able to effectively allocate their capital. And we see their operating margin, as we mentioned earlier, operating efficiency increasing year on year from 16% in 2015 to 54% in 2024. On top of that, the free cash flow margin, a pretty similar story, 45%, very attractive to an investor or potential investor, looking very strong for some very important metrics. And the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, 0.00 every single year and expected next year, meaning it wouldn't even take them one day to pay off all of their debt net of cash on hand. Balance sheet looking very strong based on this information. So let's jump into the essential valuation. And for today's episode, we're just going to take a look at the one model which makes up our valuation, which is the discounted cash flow model for Nvidia. So we have inputted, as you can see here, the free cash flow year on year. We have the average growth rate and the discount rate. Now, forward looking, we've gone for what we believe to be a low growth rate at 55%. Bear in mind, for next year, as we mentioned, they are expecting a 100% growth rate. So you could argue we've gone a bit conservative, but this is year on year. So again, it really depends as an investor what your metrics investment thesis is. Based on the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to equity value, divide by shares outstanding, and we get to our intrinsic value, which shows a little sign of undervaluation, $893 versus $878. Now, you could be arguing that you would be liking a larger growth rate forward looking. So at 60%, as we can see written there, it takes that intrinsic value to $1,176, giving us that 34% upside. Now, again, you may be expecting even higher than this at 65%, and we can see here 65% would take it to around $1,540, and that would be an implied upside of 75%. So it really does depend. We do have analysts targeting around $1,500 to $1,600. This would imply a growth rate of nearly 65% every single year for the foreseeable future. So it really does depend on what you see. We've gone here, as we mentioned earlier, for 55%, which is towards the lower end of this spectrum. In terms of the intrinsic value then for today's episode, it is getting to $893. And don't forget, you can grab a copy of this model if you want to get to your own intrinsic value, your acceptable buy price, as well as your own margin of safety. All you have to do, click on that pinned comment below, and these can be companies in your own portfolio or on your watch list, or even if you want to run through Nvidia based on your own estimates and judgments. So we use a margin of safety of 10% as always if it meets 3 criteria: a wide moat, strong financial metrics, and good forward-looking data. If we believe that, then it's a buy at around $803, so it doesn't quite have that right yet. In terms of a 5% MOS level, not even right now, it would have to be around $848. So we see Nvidia with really no margin of safety, trading at its intrinsic value. A lot of people could argue that for a high quality stock, you would be even buying it at a premium, let alone its intrinsic value. So it does come down to your individual investor's preference. If you were looking, however, at a 15% margin of safety, you would be looking to buy around $759, and at 20% around $714. Now, in terms of Wall Street and their forecast, we have different price targets from analysts from going from $1,600 to $900. So it really does depend. We've taken sort of the average of the majority of analysts at around $1,000, and that is around upside of 14%. Now, personally, this isn't one I hold directly. I do hold it directly through a few different ETFs, but I would need to see the price come down substantially lower before considering adding this as a position. But I do believe overall the future is bright with Nvidia, as they do hold a very large market share, as we discussed, and this isn't an area that is going to essentially fade away over the next year or two. But I'm interested to hear your thoughts, whether or not you see Nvidia growing consistently over the next few years, what you think about the growth rates forward looking, whether or not you're even buying it or you're sitting on the sidelines, or I know a lot of people are holding, and whether or not you have a price in mind before you want to sell. As always, let me know in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button as always. And finally, just to let you know that we have released our latest free weekly article. If you want to gain access to this as well as other articles that we have all completely free, click on that pinned comment below, sign up instantly, and you get access to all of these articles. As always, have a great day. If you enjoyed the episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one. Take care for now.